Hey everyone, it's Imran back with another macro option spotlight. Okay, investor sentiment, as we have said, has turned more bullish. We've got a lot of these sentiment readings have flipped. People chasing the price action over recent months, celebrating the idea that we might have dodged a recession, or at least it's next year's problem. We're probably not going to get one this year. That's what some people are saying, looking at the data. Now, we see a few things in the near term, however, from a market perspective that are worth exercising some caution. So Goldman's have analyzed the size of market drawdowns that follow a sharp decline in breadth. Looking at the chart, we can see that when we've had such a sharp decline in breadth as we've had recently, with very few names rallying, everything else kind of going down, the 6-month period that you see after that, from the peak to trough drawdown, that tends to be 11% versus 4% when you don't see that type of breadth rollover. Okay, so the idea is that if and when we peak, because the breadth has been so bad, expect quite a bad drawdown, is basically what the data is saying, right? And they look back at data since 1980. There's a reasonable amount of data. Okay, so that's something to be aware of. So the peak might not be in yet, but when the peak is in, the peak to trough decline tends to be bigger when we've seen this sort of precursor with with market breadth. Okay. Now, the other immediate concern, I would say, would be that the buyback blackout is well and truly on. So right now, 60% of S&P companies are in buyback blackout. That is going to rise. Again, this is data from Goldman's. It's going to rise to 85% by the end of the week. And we know that buybacks tend to be a large marginal buyer of stocks, right, which is supportive of stocks generally, why stocks just keep going up no matter what happens. And then we've also got quarter end rebalancing coming up, which is pretty much has to be a sell equities, given how equities have done over the last quarter. So if you've got the buyback bid going away, you've got a big seller coming to rebalance their portfolios at the end of the quarter. Which way do you think the market's going to go into month end, right? So whether it goes up or down, we'll find out. But the balance, there seems to be an imbalance if the buyback bid is shrinking, and if we think there's a big sell order coming for quarter end, something we need to be aware of and cautious about, right? So just don't get yourself too long ahead of that. That's not to say you don't buy the dip if the dip comes. And again, maybe the dip doesn't come because everyone's thinking the same thing. Remains to be seen. But right now, from the data, sentiment's flipped a bit bullish. People have chased this rally. Maybe they're already long now. And then maybe there needs to be some flushing out of that positioning. Okay, so, and also seasonals don't look amazing for the next week or two either, right? So there's a few factors that make me think, and I've been saying it, so it's no news to you, but I do think after tomorrow's VIX expiry is out the way, that also removes some artificial support to the market, which I've been talking about on my Twitter posts. Check them out if you haven't already. But once that goes, there's a window between, say, now till tomorrow and the end of June, so next Friday, where I would expect the market to come down. That doesn't mean we're going to 4,000. I'd say if we get to 4,300, we've done well. And then you can look to the upside and decide what you want to do for the nenext leg higher, if that's what you believe is going to happen. But right now, I'd be a little bit more on the cautious side. Okay, looking at our dashboard, what did we see yesterday? Stocks trading softer after the long weekend. They did bounce off the lows. We've got some big housing starts data coming stronger than expectations. It was like an 11 sigma beat, but that is not a normal distribution by any means, the housing starts. Anyone who thinks it is like smoking something. So really, sigma doesn't mean a lot, but it's just a funny statistic to see 11 sigma. Because if something's 11 sigma, it means it happens like once every 5,000 years. So that's just quite funny, really. Anyway, China stocks were down 4%. Stimulus measures pretty much underwhelming so far. China growth keeps getting downgraded by all the banks. Stocks were down 4% on FXI. Commodities joined the weaker tone as well. Dollar did recover very slightly, and bond markets recovered as well. TLT was up small. In terms of sectors, energy sector got hit the hardest, down 3%. We had flagged that in our weekly that owning puts on that sector might be good value. Check out the weekly if you haven't already, just to get a flavor of what we're talking about generally for markets. And then the ARK ETF that we are expecting a bit of a pullback on held up quite well thanks to Tesla, which was up another 5% odd, and crypto, which is doing pretty well because Bitcoin's deciding to catch fire. Bitcoin's gone from like 26K to 29K in a matter of days. So something going on in Bitcoin. Talking about BlackRock ETF coming out. Again, Crypto Weekly subscribers will know all about crypto that I put out last night. But basically, there's a BlackRock ETF that is in for approval by the SEC. You've got the likes of Fidelity, Citadel, all getting together to launch a crypto exchange. Basically, the establishment players want their piece of the pie in crypto. And whilst they're attacking Coinbase and Binance, who were the innovators who started all of this, now the big boys are saying, all right, you lot can get sued by SEC. We'll come in and we'll take the market share, right? That's kind of what seems to be going on. But for now, it's a net positive for Bitcoin in terms of price, and it's roofing. Okay, looking, that was a bit of a sidetrack on crypto. But anyway, back to this dashboard. Equity skew recovering slightly. Remains near the lows, though, across most indices. VIX upside remains bid as call buying continues. Commodity, FX, and bond skew were all generally a little bit firmer across most names, whereas sector skews got offered except for energy, which was firm. And then implied vols had an uptick across markets. Here you can see nothing too crazy, plenty of room to rally still. VIX remains under pressure into expiry tomorrow as we have a large open interest of upside rolling off. And I believe that's going to keep pressure on the futures until that's gone. Commodity vols were also higher, particularly across energy. Sector vols catching a bid as well for energy, financials, and miners. So the more cyclical parts of the market. And then stock, most sort of stock indices are back in positive carry, except for China. And then looking at commodities, the big negative there is silver, because it dropped 4% yesterday and implied vols barely moved. So a nice big move. Remember, what does a 4% drop mean? We have to multiply it by 16. So it's a 64 vol move in silver. So in terms of on the day, it was a 2.75 sigma daily move. And yet the implied vol went up by 60 basis points, which is not a lot. Okay. So interesting there, but that's what's taken silver into deep negative carry. And then lots of red in FX, suggesting that FX vols are on the cheap side, particularly Swissy and Euro. And finally, bonds also flipped into negative carry for both TLT and HYG. So we're not seeing a lot of point in selling vol in FX and bonds right now. There is some juice to extract in some equities. ARK is still pretty juicy as well. Look out, we're gonna be publishing some carry trades more regularly now, trying to create a bit more of a systematic framework for carry trades, which I think are very popular and need to be popular in this low vol regime we seem to have found ourselves in again this year. So watch out for that. Okay, and then today's sort of highlight idea asset that we're looking at is dollar yen. So looking at dollar yen price, you know, you can see here that we've obviously been rallying pretty hard in line with yields just backing back up again. But we saw that big explosive move up to 140. Then we had a correction and now we've pushed a little bit higher. Now, usually, you know, these moves are kind of in sync with what's going on in 10-year yields in the US, because Japanese yields just sit there and don't move, and US yields move around and dollar yen moves in line with that. You can see US 10 years kind of stalled out, whereas dollar yen has continued to push higher despite US yields not moving. We've also seen Japanese 10-year yields go back to the lower end of the range at around 37 bips. So they've been trading in that range between 37 bips and 50 bips, which is the cap. They've been trading in that range all year, except for that little departure down there in March, right? Which happened because of the banking crisis. So basically the fact that we're back down here at the bottom of the range in Japanese yields, we've stalled out on US 10-year yields. We've got month end coming, which is probably a net buy in bonds versus a sell in equity. We've also got Japanese CPI on Friday. And there's very little expectations now priced in at all for a Bank of Japan move, because they just keep holding it steady. I would argue that even though I don't believe the Bank of Japan are going to do anything, I just think it's been completely priced out of the market. So the probability, you look at the skew, if we look at the dashboard, look at the skew in dollar yen, it's collapsed, right? So whilst dollar yen has rallied, the skew on dollar yen was pumped for a large part of this year has been pumped because people were fearful that Bank of Japan was going to lift the cap and yen was going to suddenly appreciate. That has collapsed recently, so it's back down to the low end of the range. We've got you know, the strategy compass saying buy puts because spot's high, vols back down to the lows. So buying puts on dollar yen looks like not a bad trade going into the next 2 weeks, where you got CPI in Japan and you've got month end across, you know, which is going to impact all bond markets. And if yields come lower, that should take dollar yen a little bit lower as well. So that's what we're looking for. How would we play it? So I'm looking at the trade. All right, that's it for today's trade idea. Hope that makes sense to you guys. Let me know, obviously, any comments, and I'll catch you all tomorrow. Thanks.